$500 per month, 30 years. What does that actually turn into? And more importantly, how much income can it generate? Before we look at the numbers, let's understand what we're investing in. VTI. VTI tracks the total U.S. stock market. That means instead of picking individual companies, you are buying almost the entire market. Large companies, mid-sized companies, and small companies are all included. So when the overall economy grows, VTI grows with it. The focus here is long-term growth, not income. Most of the return comes from price appreciation. So if you invest in VTI, you are betting on the long-term growth of the economy. Simple, broad, and designed to compound over time. Now let's run the numbers. You invest $500 per month, every month. No timing, no trading, just consistency. Year 5, $36,000. 5 years in, and it still feels small. That's where most people start to doubt. Because the effort feels bigger than the result. Year 10, $90,000. Better. But still not life-changing. This is where a lot of people quit. Not because it doesn't work, but because it doesn't feel like it's working yet. Keep going. Year 15, $170,000. Now it starts to feel real. Year 20, $295,000. Now your money is doing more work than you. Year 25, $480,000. Year 30, $750,000. Same $500 per month. No changes, just time. Now convert that into income, $750,000 at 2%, about $1,500 per month. At 3%, about $2,250 per month. At 4%, about $3,000 per month. Same portfolio, different income levels. Now let's look at SCHD. SCHD focuses on dividend-paying companies. These are typically stable businesses with strong cash flow, companies that consistently return money to shareholders. So instead of only growing, SCHD also generates income. You receive dividends regularly, and in this scenario, we reinvest all dividends. Because that's how compounding actually works. Compared to VTI, SCHD usually grows slower. But in exchange, it produces higher income. Now, same scenario. $500 per month, 30 years. Dividends reinvested. Year 10, slightly lower than VTI. Year 20, still behind. Year 30, smaller total portfolio, but yield is higher. Now income, around $2,000 per month, without selling shares. Now compare. VTI, $750,000, about $2,250 per month. SCHD, smaller portfolio, about $2,000 per month. Very close. That's the part most people don't expect, because people think income comes from yield. But it doesn't. It comes from size. A larger portfolio with lower yield can generate the same income, or even more. Now let's scale this. $1,000 per month. After 30 years, VTI becomes about $1.5 million. At 3%, that's about $4,500 per month. Now $2,000 per month. After 30 years, over $3 million. Now you're looking at $8,000 to $10,000 per month. Same idea, just scaled. Now change one more thing. Start 10 years later. Instead of 30 years, you only have 20. Now VTI is around $295,000. Income drops below $1,000 per month. Same strategy, completely different result. So what actually matters? It's not just which ETF you pick. It's when you start and how long you stay. Because $500 per month, over time becomes $750,000, becomes over $2,000 per month. Not because of complexity, because of consistency and time.